Hello dear students, I am Dr. Binoy Rekal, Associate Professor, Department of Commerce, Bhopal School of Social Sciences. The main objective of this module is to introduce you to one of the most important tool of financial statement analysis, that is ratio analysis. Ratio analysis is considered as one of the most powerful tool of financial statement analysis. Financial analysis helps in judging or assessing the profitability position, operational efficiency as well as solvency position of an organization by establishing relationship between the items of the balance sheet, which is also termed as the position statement, as well as the items of profit and loss statement, which is also termed as the income statement. Ratio analysis is a quantitative relationship between two or more accounting variables in the process of decision making. Mere calculation of ratios are not enough. It has to be followed by analysis and interpretation. Analysis basically means simplification of financial data through methodological classification, whereas interpretation means to draw conclusions on the basis of the data so simplified. These are the major classification of ratios. First one is activity ratios, which is also termed as efficiency ratios or turnover ratios. Second category is solvency ratio, which can be broadly classified under two heads: short term solvency, which is also termed as liquidity ratios, and long term solvency. And the third category is profitability ratios, which can be bifurcated under the following three headings, that is general profitability ratios, overall profitability ratios, as well as profitability ratios related to investors. In this module, we will be covering liquidity ratios, which is also termed as short term solvency ratio. Under liquidity ratios, we calculate current ratio or working capital ratio. The formula for calculating current ratio or working capital ratio is current assets divided by current liabilities. What are current assets? The assets which are in form of cash or which can be easily converted in form of cash. Debtors, bills receivable, stock, cash in hand, cash at bank, all that comes under the category of current assets. And what are current liabilities? The liabilities which the organization has to pay within a very short period of time. Creditors, bills payable, outstanding expenses, short term loans, all that come under the category of current liabilities. For calculating current ratio, as I said, the formula is current assets divided by current liabilities. The second ratio that we calculate under liquidity ratio is liquid ratio or quick ratio or acid test ratio. The formula for calculating liquid ratio is liquid assets divided by current liabilities. For calculating liquid assets, from current assets we need to deduct the total of stock and prepaid expenses. And once we deduct stock and prepaid expenses from the total of current assets, we get liquid assets. The third formula under liquidity ratio is absolute liquid ratio. The formula for calculating absolute liquid ratio: absolute liquid assets divided by liquid liabilities. For calculating absolute liquid assets, the formula is cash balance plus bank balance, which is also termed as cash or cash equivalent. In this, we add marketable securities. For calculating liquid liabilities, the formula is current liabilities minus bank overdraft. The ideal quick ratio is considered as 1:1, and the ideal absolute liquid ratio is considered as 0.5:1. We'll try to understand the calculation of liquidity ratios with the following example. We have a balance sheet of ABC Limited. Under equities and liabilities, we have share capital which is equal to 25 lakhs. Reserves and surplus, it is 50,000. Under non-current liabilities, we have debentures amounted to rupees 10 lakhs. Under current liabilities, we have three current liabilities: trade payables 5,50,000, bank overdraft 50,000, and short term borrowings 4 lakhs. The total of liabilities is 50 lakhs. In the assets, we have tangible assets. The total amount is 30 lakhs, and we have non-current investments, that is rupees 5 lakhs. Under current assets, we have three current assets, that is inventories amounting to rupees 5 lakhs, trade receivables amounted to rupees 8 lakhs, and marketable securities amounted to rupees 2 lakhs, and the total of assets, that is also 50 lakhs. On the basis of this balance sheet, we need to calculate the liquidity position, wherein we will be calculating the current ratio, we will be calculating the quick ratio, as well as we will be calculating the liquid ratio. The formula for calculating current ratio is current assets divided by current liabilities. In this case, current assets includes inventories, trade receivables, and marketable securities. So, we need to add these three items, that is 5 lakhs plus 8 lakhs plus 2 lakhs. The total is coming 15 lakhs. For calculating current liabilities, we need to add trade payables, bank overdraft, and short term borrowings, that is 5,50,000, that is the amount of trade payables, 50,000 is the amount of bank overdraft, and 4 lakh is the amount of short term borrowings, and the total amount is coming 10 lakhs. So, total current liabilities is 10 lakhs, total current assets is 15 lakhs. For calculating current ratio, the formula is current assets divided by current liabilities. So, 15 lakhs divided by 10 lakhs, the ratio is coming 1.5:1. Then comes the calculation of quick ratio. For calculating quick ratio, the formula is liquid assets upon current liabilities. In this question, for calculating liquid assets from current assets, we need to deduct the amount of inventories. Current assets, as we have calculated earlier, it was 15 lakhs. From 15 lakhs, we need to deduct inventories. The amount of inventories was 5 lakhs. So, 15 lakhs minus 5 lakhs, the amount is coming 10 lakhs, which means the current, from current assets, that was 15 lakhs. When we have deducted 5 lakhs, that was the amount of inventories, the total liquid asset is coming 10 lakhs. Earlier, we have calculated the amount of current liabilities. The amount of current liability was also 10 lakhs. So, 10 lakhs divided by 10 lakhs, the quick ratio is coming 1:1. Now comes the last component of this liquidity ratio, that is absolute liquid ratio. For calculating absolute liquid ratio, the formula is absolute liquid assets divided by liquid liabilities. In this question, for calculating absolute liquid assets, we have only marketable securities amounted to rupees 2 lakhs. And for calculating liquid liabilities, the formula is current liabilities minus bank overdraft. The amount of current liability was 10 lakhs and the amount of bank overdraft was rupees 5 lakhs. I am sorry, it was 50,000. So, from 10 lakhs, when we deduct 50,000, 9,50,000 is the liquid liabilities coming. For calculating absolute liquid ratio, as I said, the formula is absolute liquid assets divided by liquid liabilities. So, our absolute liquid asset is rupees 2 lakhs, absolute liquid liabilities is coming 9,50,000. So, 2 lakh divided by 9,50,000, the ratio is coming 0.21 ratio 1. Both analysis and interpretation, they are complementary to each other. So, this is the interpretation done. The current ratio of ABC Limited is below the ideal ratio of 2:1 as it is at 1.5 ratio 1. The quick ratio of ABC Limited is equal to the ideal ratio, that is 1:1. Absolute liquid ratio of ABC Limited is much below the ideal ratio of 0.5 ratio 1. It is coming 0.21 ratio 1. That means the organization's absolute liquid ratio is very adverse, and the organization should try to improve their absolute liquid assets. In the next module, I will be covering long-term solvency ratio. That's all from my side. Thank you.